All right, let's jump right into it. Today, we're tearing down the Q2 2025 earnings call for Acres Commercial Realty. We're going to get into the numbers, the strategy, and what it all really means.
So here's the puzzle, right? ACRS drops a headline earnings miss, and the stock? It pretty much goes nowhere. A flat reaction like that tells you the market is looking past the big, flashy number. So what on earth did investors see that the headline completely missed?
Okay, so here's how we're going to crack this case. First, we'll hit the Q2 numbers. Then, we'll unpack what's going on with all these mixed signals. After that, we'll talk about the broader real estate headwinds they're facing. And finally, we'll wrap it up with a trade idea for the next quarter. Let's do it. All right, Section 1, let's dig into the numbers that sparked all this confusion in the first place. So, first up, the number that got all the attention. The official GAAP number was a loss of 10 cents per share. No way around it. That's a miss compared to what Wall Street was expecting, and it's what drove all those negative headlines you probably saw. But, and this is a big but, here's the twist. If you look at how the business is actually operating, they were profitable. They generated positive earnings available for distribution, we'll call it EAD, of 4 cents per share. Now that metric, which is all about cash flow, tells a totally different, much better story. And then there's book value per share. For a REIT like this is a super important number. It came in at $27.93. Yeah, okay, it's a tiny dip from last quarter, but what's more important is that it's still up nicely from $27.20 a year ago, so the long-term trend is still positive. Now, this slide right here, it just perfectly visualizes the whole puzzle we've been talking about. On the one hand, you've got that negative GAAP number, the accounting loss, but on the other, you've got the positive EBITDA, showing that real cash is coming into the business. And that difference, that's exactly what the market decided to focus on. Okay, so how is management explaining this whole situation? Let's get into their strategy and how they're trying to navigate these really mixed signals. So it's really crucial we're all on the same page with EAD. What is it? Basically, it's a non-GAAP metric, but it shows you the actual cash that's available to be paid out to shareholders. And for Acres, their EAD swung from a pretty nasty loss of 86 cents last quarter all the way to this quarter's positive 4 cents. That's a huge turnaround, and it was mostly driven by higher net interest income. You can see here, management's strategy is laser-focused. A full 75% of their entire commercial real estate loan book is in multifamily. This isn't an accident. It is a very deliberate bet on apartments, which they see as having more stable and durable cash flows compared to other areas, like the office sector, which is really struggling right now. And they're not just sitting back. This quote from CEO Mark Fogel really says it all. Our goal is to grow the portfolio by $300 million to $500 million through the end of the year. I mean, that's not a company playing defense, right? They are on offense, actively looking to put money to work and grow. So how are they going to pull off this growth? Well, it's a multi-pronged attack. They're recycling cash from asset sales. They're using some tax advantages, these things called net operating losses, or NOLs, to actually boost their book value. They're planning a new CLO, which is basically a way to package up loans to add leverage in a smart way. And on top of all that, they're buying back their own stock while it's trading at a deep discount. It's a really comprehensive game plan. Now, this all sounds pretty optimistic, but let's be real. This isn't happening in a bubble. Acres is still operating in a very, very tough commercial real estate market with some serious headwinds. Just look at the big picture. Stress is everywhere. Delinquency rates for commercial mortgage-backed securities, which is a great barometer for the health of the whole market, they just kept ticking up over the summer. This just goes to show you that credit friction is still a huge problem across the entire sector. And if we peek inside their own loan book, you can see some of that stress too. Now, the overall risk rating for the portfolio held steady, which is good, but the number of loans in their highest risk categories, rated 4 or 5, did creep up a bit from 11 to 13. So while over 91% of their loans are still current, those riskier loans are definitely something we have to keep an eye on. And this slide, this really lays out the core bet you're making with Acres. On one side, you have the scary broad market risk, all that credit friction and rising delinquencies. But on the other side, you have Acres' very specific focus. They're betting that by concentrating on multifamily, a niche where new construction is expected to cool off soon, they can actually outperform the rest of the struggling market. So let's put it all together. You've got the mixed results, the ambitious growth plan, and the tough market risks. What does this mean looking forward? What's our thesis for the next call?
For us, we see a really clear 4-step path to victory for management here. Step 1, they absolutely have to hit that growth target of 300 to 500 million. Step 2, they've got to execute that CLO to get their leverage up efficiently. Step 3, they need to turn all those new assets into real, sustainable EBITDA. And it's a big if they can do all that, then step 4 is the big prize, a potential re-rating of the stock as the market starts sniffing out that a dividend could be coming back in 2026.
Okay, so for our next call segment, here's a potential trade idea. You could think about a pair's trade, go long ACRES, but short one of their peers, maybe someone with higher leverage and a lot more exposure to the troubled office sector. The whole idea is that you're betting on ACRES' focused multifamily strategy and their unique advantages, like those NOLs in the planned CLO, to help them outperform the weaker players in a market that's still pretty beat up. You're basically betting on their specific execution versus the general market gloom.
So, because of this potential for management to really execute on their specific plan and navigate these broader headwinds, we're kicking off our coverage with an outperform rating. The roadmap is there. Now it's all about the execution. And as always, just a quick reminder, this is for informational purposes only. This is not financial advice. Please do your own research.